Hello everybody and welcome back to lecture number 2 of Ind AS course that is fully recorded in English. Okay. Now this lecture is in continuation with lecture number 1. There we have covered this last slide which said that any economic resource that need to be recognized as an asset must have 3 key aspects. What are those? Those are right, control and potential of economic benefits, of future economic benefits. Okay, we read this. Now these pointers will be elaborated further and in detail we'll see when right is considered, when control is considered, and what do we actually mean by potential to produce economic benefits. Okay, other than this, one important note that we discussed in the last lecture, but I want to highlight it again, that as per the rule, as per the principle, each and every right is considered a separate asset. Okay, for example, I talked about the land. Okay, now but as per for the accounting purpose, all these rights are clubbed and accumulated and considered as one asset. Okay, let's begin with our concepts. Okay, now we will talk about all 3 key aspects. First aspect was right. Let's begin. Obligation of another party. Obligation of another party. Whenever there is obligation of another party, it will be considered your right. That means the other party, the third party, has a responsibility to fulfill either cash, goods, services in any format. Okay, in any form. But if they have any responsibility, duty, obligation, then in contrast you have an asset, you have a right. Okay, let's see. Obligation of another party, there is right to receive cash, goods or services, rights to exchange economic resources with another party on favorable terms. If it's favorable for you, if it's bringing you positive effect, okay, on that exchange you will be having some favorable effect, that means some positive inflow, then that will be considered as right. Whereas on the other hand, if there is an unfavorable, then it will be considered as liability. Okay, so right means what? If another party exchanges resources and you have, and they are exchanging on the favorable terms which are in favor of you, okay, then it will be considered right for you. Rights to benefit from an obligation of another party to transfer an economic resource if specified uncertain future events occur. For example, insurance company. Okay, a good example is insurance. What over here means, for example, in case of any fire, flood or etc. Okay, what you have a right to claim, amount, okay, some cash amount from that insurance company. Okay, so in this case what happens, you have any right which is based on, which is contingent on happening or non-happening of some event, that is uncertain future event. Okay, for example, say an insurance claim receivable upon happening of an insured event. So these are right in the form of that other party is having obligation towards you. Now next, if there are cases when the other party does not have any sort of obligation, but still it's a right for you. How is it possible? For example, you have right to sell a particular economic resource. You have a right to sell that particular asset, but the other party does not have an compulsory obligation to buy it from you. Okay, is it clear? Even though if the other party is not having any sort of obligation towards you, still your right to sell is a right over here. Okay, so read it again. When no other party has any obligation, rights over, for example, rights over physical objects such as property, plant, equipment or inventories. For example, right to use intellectual property, that means intangible assets and all. Right to use, sell, pledge, etc. Mortgage. What does pledge and mortgage means? Let me clear. What? You are putting any sort of asset or economic resource as a collateral for any loans and all. Okay, so collateral can be put either movable property or immovable property. If it is put, if the collateral is movable property, then the term used is pledge, and if the collateral that is being put is what? Is immovable property, for example land and all, then that is termed as mortgage. Okay, so both of the meanings, pledge and mortgage, together can be known as collateral. They are forms. If movable property, then pledge. If immovable property, then what? Mortgage. Okay. Intellectual property is a broad categorical description for the set of intangible assets. These are intangible assets owned and legally protected by a company or individual. For example, you have taken copyright against any intangible asset. Okay, so this together is known as intellectual property. So we are talking about right. When there will be a right, first case, if the other party is having any sort of obligation. Second case, if other party is not having obligation but you still have right to use, sell, pledge, etc. Thirdly, contractual legislation or similar means. Contractual legislation means due to any contract or due to any law. If you have dealt any contract, then you have to work according to that. For example, 1 year I have considered a bond for you. Okay, that if you leave before this, you will have to pay 1 lakh rupees. Okay, this is a contract signed between us. In case if you act in manner other than prescribed in this contract, you will have to pay 1 lakh rupees. So this is your right to receive 1 lakh rupees because of contract. Because of contract. Due to any law. Okay, it can be due to any law, that any provision is prescribed in the law and therefore you are receiving any amount or you have right to receive any amount. Then this is known as a right due to legislation. For example, you are taking your company is asking you to leave. Okay, so that retrenchment compensation is given to you. You have right to ask for that retrenchment compensation. Okay, so see, an entity might also obtain rights, for example, by acquiring or creating know-hows. What does mean obtaining or creating know-how? That is not in public domain. For example, you have created something or there is something available on the Google. So it is not your individual property. Though you can access it, though you can use it, but it is not exclusively your property, because it is available in the public domain that anybody, anywhere, anytime can access it. For example, there is a bus stop. You have right to sit over there, wait for the bus, okay, etc. But still, you do not have any sort of control over it. Got it? So therefore, that right, since it is available in the public domain, it is not exclusively your right. Therefore, it will not be termed as an asset and recorded as an asset in your books of account. Okay, this simple line is being told over here. By acquiring or creating know-how that is not in the public domain, that is not in the public domain, then it will be considered as your exclusive right. Through an obligation of another party that arises because that other party has no practical ability to act in a manner inconsistent with its customary practices, published policies or specified. You have to learn this, okay? Because of customary practices that it is normal business practice that they carry on such action or such provision. Okay, for example, there if you go and purchase a fridge or a washing machine, it's their policy that they deliver to you. Okay, so that is their business policy, that is their customary practices. Published policy, that is written in their terms and conditions and has been published in their annual accounts and all. Okay, or specified statements, other statements, often referred to as constructive obligation. This is always termed as constructive obligation. If you have submitted something, you have contracted something, you have written down and published any sort of provision, then that is known as your constructive obligation. Due to that constructive obligation, you will have to act in that particular manner. Okay, and you are expected to act in that particular manner. Okay, so due to that obligations and all, you have right. Due to such contract, you have right. Due to such law, you have right. Okay, third case. And fourth, when rights do not constitute asset. For example, it is right, but it does not constitute what? Asset. See, for example, rights are available to all parties without significant cost. For example, if any of the knowledge is available in the public domain, if any of the knowledge is available in the public domain, it won't be considered as your exclusive right. Entity cannot have a right to obtain economic benefits from itself. For example, treasury shares. What are treasury shares? if you buy back, if you have issued any shares, and if you buy back those shares, if you repurchase those shares and keep it as in your with yourself, then those shares are known as treasury shares. Those shares are known as treasury shares. So it can be benefited from those shares. So it is prohibited that it won't be considered as your asset if you are getting benefit from itself, okay, from your own things. For example, entity cannot have a right to obtain economic benefits from itself. For example, treasury shares. Investment in one another entities within group. For example, the group companies have invested in one and another. Those will also be not considered as right. In case of any doubt, please ask. I'm waiting for it. Treasury shares means instruments issued by the entity and repurchased and held by it. Okay, they have been bought back. Or you can say buyback. This is a popular term. The company repurchases those shares and keep it with them. Okay. Is it alright? Can we move ahead? We have learned 3 key aspects. First was control. We have learned control and 4 points we have learned about that. Next comes control, and other than that comes future potential of future benefits. Okay, can we move ahead? Let's do it. There are 2 examples to make your right concept understand better. Example number 4. Ownership of land gives the entity the right to use the land, right to sell the land, right to give land on lease. Okay, the land can be used, can be sold out, or can be put on lease, or can be pledged, that is, can be put as collateral to obtain a secured loan, etc. However, these rights are normally bundled up as a single asset for the land for the accounting purpose, and but for the principal purpose, all these, each and every right is a separate asset. As such, classification provides a faithful representation. What does faithful representation mean? We have discussed in the last lecture also. Faithful representation over here means 3 points were given. It should be complete, it should be neutral and free from errors. And that also includes what? That perfect, or you can say proper amount should be recorded, proper class should be identified of those rights in the most concise and understandable way. Okay, any doubt? No. Though that note was associated with this example. Example number 5. An entity and another entity might have any dispute about the amount. Okay, for example, you have a debtor and there is a dispute going on. So, it might be contingent that you will be receiving the full amount, partial amount, or no amount. Okay, so till the time that disputes get solved, it will not be considered as your right. Okay, see, read this. Until where the entity has a right to receive an economic resource from other party. Until that existence of uncertainty is resolved, for example, by court ruling or any other mutual settlement, it is uncertain whether the entity has a right or not, and therefore consequently whether an asset exists, and therefore it is very much in dilemma that asset exists or not, and therefore we will conclude it as that asset does not exist. Okay. Next concept of potential to produce economic benefits. This is next key aspect of the asset. Role of probability. See, this is very important because questions come on this. It does not need to be certain, fully certain. No, even likely, that mostly it should receive it. Okay, there should no, even if there is low probability, still it will be considered as your right, still it will be considered as your asset. It does not need to be certain, 100% sure, or even likely, that most probably that the right will produce economic benefits. A right can meet the definition of an economic resource and hence can be an asset, even if the probability that it will produce economic benefits is very low. Even if there is low probability, a particular right can be considered as asset. Even if with low probability, a particular right can be considered as asset, even if there is very, very, very low probability of, less chances of gaining economic benefits from it. Okay. Role of timing. Potential means future economic benefits, because current we know. Okay, we do not have to make any sort of approximation, but for the future we have to see the capacity, the potential that it has. Okay, and estimate accordingly. So potential means over here is future economic benefits, but economic resources means the present right. Your economic resources means the present right that contains that potential. Okay, right is what that contains the potential, and potential is what the future economic benefits. Are you clear? Are you clear that the present right is what the economic resource is, what the present right that you have currently, and its potential means that in future you will be receiving any sort of economic benefits. Now example is given. Okay, for example, read this. Receivable from a bankrupt customer. A customer has gone bankrupt. Okay, you have a right to receive from that person, but might be since that person, that entity is bankrupt, you might receive no penny from that. So even if the measurement principle renders that net carrying amount of such an asset is nil, even though you will receive nothing, negligible amount, still you have a right to collect from there. Okay, so there is difference between right and future economic benefits. Okay, even the customer has gone bankrupt, you still have a right. Okay, but that asset will faithfully be represented as value nil or any some notional amount. Okay, next, role of expenditure. There is a close association between incurring of expenditure and acquiring of asset. Okay, there is a relation between them, but the timings might be too different. You have given advance and you will be receiving the asset after 6 months. It might be the case. You have received the asset and you will be paying after a year. It can be possible. So the paying of the asset, paying for the asset, and receiving of the asset, acquiring of the asset are two different things. Though they are interrelated, but the timings can be entirely different. Example, asset can include, for example, rights that a government has granted to the entity free of charge, that another party has donated to the entity. Okay, or that either any other party has donated them, or it has received from the government for any for no cost. Okay, but still they have right. For example, if you talk about grant, you'll study this in chapter number 5, unit number 1, about the grants, when you talk about that specific Ind AS 20. Okay, but now you understand, if you have got something from government without paying any cost, or you have received anything from other party as a donation form and you have not given anything in exchange, still there is acquisition of asset, there is a right. Okay, so it is told that they are quite related, but the timings can be different, and might be that there is no cost at times, but acquisition of asset is there. Now example of the concept. For example, a purchased option derives its value from the potential to produce economic benefits through exercise of the option at a future date. Okay, how do we calculate this? We calculate this by seeing the capacity. Okay, for example, there is an entity. Okay, there is an entity and you have to see its future value. What you do if there is no market price available, no income, then what you do? You simply calculate their future expected cash flows, inflows and outflows, and do its present valuation, and then sum up and see that what is its present value, what is its valuation on current date. It is a technique. Now what you have done, you have explored the future potential, future benefits that it could produce, and you have now done it as present value, economic benefits through exercise of the option at a future date. However, the economic resource is a present right. See, you are calculating about the future, but it's a present right, the right to exercise the option at a future date. The economic resource is not the future economic benefits that the holder will receive if the option is exercised. The economic benefit is the present right and not the future economic benefit that it will receive. Therefore, even low probability is considered as a right and recorded as an asset. Are you clear? Please, in the chat box, write down clear if you are okay with it, or ask doubt if any. Let me know. if you are okay with this, if you are clear with this, we will head towards third aspect, that is control. What are we reading? We are reading the 3 key aspects of the asset when an economic resource will be considered as an asset. Are you clear? Good, clear. Okay. Now comes the third concept. Present ability to direct the use. It has the right to deploy that economic resource in its activity or to allow another party to deploy such economic resource in other parties' activities. Okay, you will be entitled with a control if you have power to use those resources or direct those resources, control the use of those resources, direct any third party or other party to use those resources or not to use those resources. Okay, if you have those power, then you will be said, your entity will be said to be in control. Okay, present ability to direct the use. This means either you will be using it or you have whole soul power to direct that other party can use it or not to use it. Okay, see, deploy means applying those resources. It has the right to deploy those resources, those economic resources in its activities. Okay, it has right to use those resources in that economic resource in its activities, or to allow another party to deploy or use or apply those economic resources in that other party's activities. Okay, either you can use it or you can direct its use by another party. Then you will be termed entitled as that you are having control over that asset. Next, obtain economic benefits. If it means that if the resources produces economic benefits, the entity is the party that will obtain them either directly or indirectly. Entity is one of the party that will be receiving those inflows. Okay, for example, there is any sales and there is revenue. If the entity is entitled to receive those sales amount, those sales revenue, if there is final sale and there is scrap value received, if the entity is entitled to receive those scrap value, then it will be termed as that the entity has control over that asset. Okay, see again, read it again. It means that if the resources produce economic benefits, the entity is the party that will be obtaining entire of the economic benefits or major portion of those economic benefits, either directly or indirectly. Okay, control also includes what? Present ability to prevent other parties that not to use my resources. Okay, you will be entitled to have a control over a particular economic resource or asset if you have power to decline, deny or refuse to any party that please stay out of it. You cannot use such particular resource or such particular asset. Okay, so present ability to prevent, to deny, to refuse other parties that from directing the use of the economic resources and from obtaining the economic benefits that may flow from it. Okay, it has full right over it, full control over it if it has power to deny any other third party. Okay, to allow any third party or deny or refuse any third party. Okay, both will be termed as control. It follows that if one party controls an economic resource, no other party controls that resource. Okay, it should not be it can be on shared basis, there can be a ratio, but it should not be available in the public domain. It should be exclusively their right or their portion of right. Okay, see, control usually arises from the ability to enforce legal rights. If it is not done that way, you can take legal actions against it. Entity could control a right to use know-how is not protected by a registered patent. Even though it is not a copyright, still they can use it and protect it. Okay, for example, anything that is not legally have been protected by the law, but still these are your economic resources. For example, you have 100 chairs. Okay, maybe they are not protected due to any legal format, but still you have a right to enforce and protect your own assets. Okay, for example, know-hows, you have not taken any sort of copyright, trademark, okay, etc., but still you can protect your know-hows or intangible assets. So it will be considered as control. It will be considered as control even though they are not registered or protected by the law. Next, would control exist with the principal in a principal agent relationship? Okay, so if principal is there, principal means who owns, principal means what? Principal simply means who owns that asset, okay, who bears all the risk and reward is the principal. If those risk and reward gets transferred to the agent, then agent will be considered as owner of that asset, can record that asset and see and be known as control has been transferred. If such control has been transferred from principal to agent, control transferred, then only we will see that ownership has transferred, okay. Otherwise you will not be considering as ownership has transferred. There are simple examples given that will make it more clear. Sometimes one party, that is principal, engages another party, an agent, to act on behalf of or for the benefit of the principal, okay. The agent acts on the behalf of principal and for the benefit of the principal. It only has the interest of taking the commission portion for the act that he is doing. For example, a principal may engage an agent to arrange sales of goods, okay. Principal can ask an agent that please arrange a sale or sell these goods on behalf of me, controlled by the principal. If they are controlled by the principal and control has not been transferred, okay. If an agent has custody of the economic resources controlled by the principal, that economic resource is not an asset of the agent. Since the control still lies with the principal, therefore even if the agent is having the custody, the physical possession of it, then also the assets will be recorded in the books of accounts of principal and not the agent. Okay, read it again. Even if the agent has custody, that is physical possession of an economic resource controlled by the principal, that economic resource is not an asset of the agent. Furthermore, if the agent has an obligation to transfer to a third party an economic resource controlled by the principal, still the control lies with the principal, okay, and it has responsibility to transfer such any good, asset, cash, anything. That obligation is not of the agent, it is all of the principal. Control transfers, then only it will be said that asset or liability has transferred, because the economic resource that would be transferred in the principal's economic resource, not the agent's. Got it? Next, definition of a liability. Okay, entity has an obligation. Obligation means responsibility to transfer any economic resource. Responsibility or duty to transfer any economic resource. Either it can be cash, goods, services. Okay, entity is to transfer economic resource. Present obligation as a result of past events. In past you have done something, you have contracted or dealt anything, you have promised something, you have dealt into a transaction, and due to which you have to what, there arises an obligation and you have to fulfill that. Then it will be known as present obligation as a result of past event. An obligation is a duty or responsibility that an entity has no practical ability to avoid. Okay, now the entity cannot avoid it. They do not have option either to fulfill or not. It has obligation, it has duty that they have to fulfill such particular transfer of economic resource, either cash, goods or services. Okay, whichever the way is promised. Now first comes, okay, according to this 1, 2, 3, we will be deep diving it, okay, in detail. Firstly, entity has obligation. Whether an entity's duty to transfer an economic resource, that is conditional on an action. It is conditional on an action, dependent on an action that an entity itself may choose. If entity has an option, and it is dependent on that option that either they have obligation or not. Okay, see what we have read just now, that entity should not be in any sort of practical ability, capacity that they can refuse, avoid such obligation, such transfer of economic resource. Okay, then only it will be termed as obligation. If they have option, it will not be termed as obligation. Okay, so in such situation the entity has an obligation if it has no practical ability or no practical capacity to avoid taking that action. A conclusion that it is appropriate to prepare an entity's financial statement on a going concern basis also implies a conclusion that the entity has no practical ability to avoid a transfer that could be avoided only by liquidating. Okay, so there is an obligation, there is an outflow or economic resource, okay, and that will be done at the point of liquidation. So that can be avoided if you are not going into liquidation, and it is assumed that you are working on going concern assumption. Okay, so if going concern assumption is taken, and usually normally going concern assumption is taken. Okay, so if you can, there is no practical ability to avoid unless and until you are going into liquidation. So since going concern assumption is there, you are not going into liquidation, it implies. Therefore, such obligation can be avoided by ceasing or by liquidating the entity or ceasing to trade, that is stopping to trade. Obligation can arise, however, from an entity's customary practices, published policies and specific statements if the entity has no practical ability to act in a manner inconsistent that has been dealt in. Okay, they have to act in the manner they have promised. Okay, they have contracted. This is known as constructive obligation. Learn this, I have told you previously as well. Okay, an obligation can meet the definition of a liability even if the probability of a transfer of economic resource is low. I have told you, even there is probability is low, then also such right will be considered as an asset. Therefore, even if the obligation is very low, the probability is there are less chances of paying off, okay, of outflow of those economic resources, then also you will be considering it as an obligation. Okay, so even low probability works for both asset and liability. Okay, next, obligation to transfer economic resource. The obligation must have the potential to require the entity to transfer an economic resource to another party. You should have an obligation to transfer such cash, goods, receive services to what? To any other third party. For that potential to exist, it does not need to be very certain, most likely, even likely, that even low probability can work. It is only necessary that the obligation already exists and that at least in one circumstance there will be an outflow. This is known as very less probability, less chances, very less chances that at least in one circumstance there will be an outflow, there will be an obligation to meet those economic resources outflow. Then also it will be considered as an obligation. Okay, very low probability of then also it will be considered as asset and liability. Third point, present obligation as a result of past event. What does this mean? That the entity has already obtained economic benefits and or taken any action. For example, you have received the services, now you have to issue ESOP shares, okay, employee stock option shares. This is an example of that this obligation arises due to the promise and due to the services that you have taken in the past. As a consequence, the entity will or may have to transfer the economic resource that it would not otherwise have had to transfer. A present obligation can exist even if a transfer of economic resource cannot be enforced until some point in the future. Present obligation still exists if for a particular date. For example, the creditor, the supplier has given you 3 months credit period. Before that, it will not obligate to pay you, that you have to make the payments. Okay, but after 3 months, the due date arises and then you have to pay the amount. Okay, even for the 3 months there, when such supplier cannot mandate or make a compulsion for you to make a payment, even though there is no compulsory obligation for you for the 3 months, he cannot, he or she, that entity cannot force you to pay. Okay, still it will be considered as an obligation. See, a present obligation can exist even if the transfer of economic resource cannot be enforced until some point in the time. Okay, it cannot ask for first 3 months for which the credit period is on. Okay, got it? So it happens due to the past event, and even there is a future commitment and no present obligation, still it will be considered as that obligation exists, liability exists. Are you clear? Let me know. We'll go through some examples of the ICI. These all examples are ICI examples. Okay. What you can do while noting down the examples, questions and the illustration part, what you can do is open your ICI module hand in hand and put a tick mark over there, highlight over there, write in your own language if you want to understand anything. It helps you too much while doing revisions. And yes, I'll be taking test after completing chapter number 1, 2 and 3. Okay, there will be a test, and I want you to write the answers in the way that I ask you to, because we want to excel in our exams. Yes, first priority is to understand the concept very nicely, very deeply. Okay, clear the concept, and once it is done, we'll attack on our questions and see how it can be solved. Okay, and after that we will concentrate on the writing pattern of the answers. Okay, these are 3 steps that I think will help you a lot in scoring in FR. Okay, are you good? Can we move ahead? All these lectures and PDFs are available in the app, so don't worry to write it down, don't rush. Okay, and the validity, as soon as you enroll for that, the validity is 1 year, and there is no restriction on the number of views. Okay, even you can view that particular video for the 100 times. Okay, there is no restriction over there, but I will make sure that you just have to view it only once and you are crystal clear about it. Okay, any feedback, any suggestion, any query, please write down to us, please reach out to us. Download the app, it's there in the description box. Okay, and write us in the chat box. I personally ensure that each and every question, answer, suggestion is taken care of. Okay, I personally reply to all of them. Can we move ahead? Please let me know. Okay, now let's move ahead with example number 7 of ICI module. Okay, in further chapters, what we'll do, we'll take the ICI module itself. Okay, so you do not have to search for the pages and all where it is written in. Okay, see, if an entity has entered into a contract to pay an employee a salary. Okay, you have contracted to pay a salary in exchange for receiving the employee services. There is an employee working for you, giving her services, and for which he or she has been hired, and against which you are making a payment in the form of salary. Simple. The entity does not have a present obligation right now to pay the salary until those all services has been received, until it has received the employee services. Before then, the contract is executory. What is executory contract? Executory contract is a contract the entity has combined right to exchange. Executory contract is a contract in which there is non-performance, okay, or there is partial performance, equal partial performance. Okay, it is equally unperformed by both the parties. Wow. In this case, for example, the employee is still giving its services. For example, there is a 30 days salary. Okay, now he has completed 10 days. Now 20 days is receiving, is still left. Now, if the employer has paid 10 days salary, then it will be considered as executory contract. It will be considered as executory. That 20 days are pending, and here also 20-day amount is pending. For example, the employee has given 1 month full service. Okay, and or it is start of the month. For example, the employee, it's 1st June. Now the whole month services are pending, and here the employer's also whole payment is pending. It is fully non-performed, unperformed on both the parties, equally unperformed. Okay, now it completes 30 days work and services. Now if it is not paying the amount equally, then it will not be considered as executory contract. But if it pays 30 days, then it will be considered as executory contract. Okay, for example, see, an executory contract is a contract or a portion of a contract which is equally unperformed. Equally unperformed. Are you aware of this fact? Okay, 10 days pending, 10 days pending. If you are building, if you are a construction company, you have built one floor out of 4 floors. So you have completed 25% of work, and the builder or the entity, the party has given and paid 25% of the amount. So this is what executory contract. This is what executory contract, that 3/4 of the work, 75% of the work is pending from your side and 75% of the payment is pending from your side. This is what equally unperformed contract, and therefore it is termed as executory contract. Okay, read it again. An executory contract is a contract or a portion of a contract that is equally unperformed. Neither party has fulfilled any of its obligation, or both parties, okay, either none has fulfilled their obligation or both parties have partially fulfilled their obligation to an equal extent. Okay, single unit of account. Some contracts establish both rights and obligations for each of the parties if those rights and obligations are interdependent and cannot be separated. If they cannot be separated, they constitute a single inseparable asset or liability and hence form a single unit of account. Okay, if they cannot be separated, then they are considered as one contract. Substance of contractual right and contractual obligation. Contractual rights and contractual obligation. To report the substance of a group contract, single unit or separate unit, it depends. If it can be separated, then separate contracts. If it cannot be separated, then single unit. All terms in a contract, whether explicit or implicit, whether expressively written down or implicit, that is, it is implied without being said while negotiating. Okay, explicit terms are what? That are being told at the time of negotiation, and implicit are those at the time of negotiation they are not told. Okay, they are not discussed again. Whether explicit or implicit, whether discussed at the time of negotiation or not discussed at the time of negotiation, are considered unless they have no substance. Always considered unless they have no substance, they have no impact on the decision making. Implicit terms, for example, obligation imposed by the statute or any law, such as statutory warranty obligation imposed on entities that enter into contracts to sell goods to customers. Okay, there are some warranty criteria. Okay, if you talk about any electronic items, it always comes with warranty, 6 months warranty, 1 year warranty, whatever, but they have to lay down. So this is what this is as per the law. A term has no substance. It has no substance. It will be considered that it has no impact, no substance when if it has no discernible means no noticeable impact or effect on the economics of the contract. Terms that have no substance could include, for example, that bind neither of the party. Rights include options that the holder will not have the practical ability to exercise in any of the circumstances. It will be considered as no substance. If it is considered as no substance, such term, okay, all terms are considered unless they have no substance. It will be considered as no substance if it has no noticeable effect on the economic decision making. Okay, either they don't bind neither of the party. This means what? That it is not imposing any sort of obligation, okay, on any of the party. It is not putting any sort of obligation on either of the party. Both are free. There are options and not obligation. Okay, they can avoid such transactions, such payments, or whatever the condition is. It is optional. It is not binding or not enforcing any of the party, neither party, or it has right that holder will never encash. Okay, for example, in any item there is a condition written, okay, that you can take this, encash it back, return it back, but there are very less chances that this party will come back and encash this. Okay, you have so much of confidence on your own product, or there has been past trend that such a customer never returns a particular asset. Okay, so even though there is a provision noted down, there is a condition noted down Okay, there is a right for the customer, but you are very, very sure that they will not exercise such a option. Okay, so in both the cases it is not impacting the economics of the entity, and therefore it is considered as it has no substance. And since such conditions, if it has no substance, it will not be considered while seeing all the terms and conditions of the contract. Either it is explicit or implicit. Explicit means expressively discussed at the time of negotiations, and implicit means not discussed at the time of negotiations. Okay, if they can be separated, then separate accounts. If they cannot be separated, then single unit. Now comes recognition and derecognition, two important concepts. What are those? Recognition means recording any particular asset or liability in books of accounts, and derecognition means reversing them, removing them from the books of accounts. For example, if we talk about income, whenever you recognize an income, what do? You do credit of such income. What do? You credit such income in your P&L. But whenever you have to derecognize it or remove it, what you will be doing? You will be debiting such amount. Okay, this is simple concept. You can relate it with your 11th concepts. Okay, the basic start that you had in your 11th standard. Recognition means recording in the books of accounts. Derecognition means removing from the books of accounts, that is, you will be reversing it. Okay, so, okay, read this on your own. Recognition of expense, what you do? While recognizing, you debit your expense, but while derecognizing, what do? You remove that expense by crediting such amount, okay, reversing such amount. Okay, and what are the balance sheet alternatives? Debit asset on initial recognition, and or increase in amount. If first time you are recording any asset, what do? You debit such asset. If you increase such amount of the asset, what do? You again debit it. If you have to lesser down that value, lower down that value, or remove that asset, what you will do? You credit that asset. Similarly goes for the liability and vice versa. Let me know in case of doubt. For example, see example number 8. The sale of the goods for cash results in the recognition of both income from the recognition of one asset, the cash, and an expense. Okay, they can be two recognitions. So you are recording the asset that has come in, cash, and expense, that means your goods are being sold. Okay, so this is, you will be derecognizing your inventory and you will be recognizing your cash inflow. Okay, the amount at which the asset or liability is recorded in the books of accounts is known as carrying amount. This carrying amount term will be repeated again and again and again and again in all the further standards. Okay, what does it mean? All the assets and liability, those are recorded in the books of accounts. The amount at which they are recorded are termed as carrying amount. Are you good? The simultaneous recognition of income and related expenses is sometimes referred to as matching of cost and income. Okay, for example, this is matching of, this is matching. Okay, this is matching. Okay, so for this lecture we'll keep it simple and short over here. Okay, after this there are some more concepts, we'll read that and head towards the ICI question and answers. Okay, I think we are good to go. Any doubts? In case of any doubts, please reach out to us. All the information is available in the link. Okay, you can definitely check it out. Other than this, what you can do is you can download the app and talk to me in person. See you in the next lectures. Till then, take care, be safe, stay tuned.